But first up, let's take a look at what's happening in the Asian markets. They're largely shut.
If you look at the unemployment rate, it remained at 3.8%.
For the Nifty, the next logical resistance is the 20-day moving average, which comes in at 19,787.
The regulator SEBI's technical advisory panel has given the green signal for MCX to shift to the new platform.
The Israeli Prime Minister Benjamin Netanyahu on Saturday said that Israel was, and I quote, going into a long and difficult war.
The first tick on the Nifty coming through with a cut of 130 points, not looking good.
Today, small and mid caps are expecting 10 out of 10, in terms of performance.
Now, IT stocks have seen a pretty smart run-up in Q2.
Well, the markets are looking at the Palestine and the Israel concerns. There is concerns about escalation of there as well.
Markets are injected with a fresh dose of geopolitical tension.
More investors joined the Reliance Retail's $100 billion club.
Now, Senco and Utkarsh have already doubled from their IPO price.
Now, counting in all the states will be on 3rd of December.
For the moment, it's Nifty, which is sitting with cuts of 130 points.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell. We're coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant. With me, my colleagues Reema and Surabhi here in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon. The market, I think, is back down again, 140 points. There was that recovery. I should say there is that recovery from the day's low, but there is quite a bit of selling pressure. Unarguably, I think that is the case, which is coming up. Let's just take a quick look at the morning low, which was about 19,480. So I think, 40 points still away from the day's low to where the Nifty is at right now. And I think that's the first number, which I think, if you're taking very short-term trades, that people will hope that doesn't break. The morning low kind of holds on to. We were pointing out in the morning that you were coming out of a decent kind of move from last Wednesday's low. The market, the Nifty had rallied 300 points. That's about a little over 1%. The Bank Nifty had done 500 points. That was about a little over 1.5%. So, you're coming up with gains. Now, you could have read it two ways. One is to say that the market is strong. It's kind of looked through everything over the last few sessions. Market is in strong shape. And that would have been okay. But over the weekend, of course, you had all these developments with regards to the war. And I think that is maybe taking a little bit of sheen off that sentiment, that bullish sentiment, which I think people went home with on Friday. Now, the banks are looking a little weaker. For the Nifty Bank, the last week's low, which is 43,857, is once again in play. Just 40 points away, right? So very, very close. Intraday, we actually broke that low. Let's see what the close is. So that becomes important. But again, that's a very near-term number. And mid-caps and small-caps, unlike what we've seen in the past, they are down even more as compared to the Nifty and the Bank Nifty. 1.25%, 1.75% cuts on the mid and small-cap part of the market. So this is a developing situation. It's a developing story coming out of what's happening there in the Middle East. And I think markets will pay attention. The first proper reaction that we will get from U.S. markets is going to be today to all that has happened over the weekend. So as I said in the morning, the better thing is to just wait and let this thing settle down before start trying to jump in. Because, you would have been right. If you bought the dip, you would have been right. But the point is, you buy the dip, you got to get out. Otherwise, you basically back it where you bought it at, or maybe even lower. So, to my mind, the thing to do perhaps is to kind of sit on the sidelines, even if you're trading very, very near term. Reema.
And it's a cautious opening across Europe right now. Yeah. The DAX lower by about 3/4 of a percentage point. The dollar index has seen continuous buying through the course of the trading session, now 106.2. On Friday, if you remember, the dollar index was well below 106, 105.5, 106.5 now on the dollar index. That continues to see a lot of safe haven buying. The Dow futures is right now down in excess of about 200 points. The problem is the second dip in the market has been far more deadly. We got a dip in the morning, but the bias at that point was to buy the dip. In fact, at one point of time, you almost thought maybe the markets will get back into the green. But the second dip in the markets has been a little more, deadly. And now the Nifty is closer to 19,500. As Prashant said, it's important for us to hold that intraday intraday low that we've hit. The sectors which have gotten hit, the PSU banking index, the Nifty PSU banking index is down more than 2% after the Bank of Baroda update also was a bit underwhelming. So that's put pressure on the PSU banking index. And the second one is metals, and that's because of the conflict that we've seen in Middle East.
Well, that's the shape of the large market. I'm looking at the selling in mid-caps because that's been a hallmark of trade right from the morning. The mid-cap index was underperforming right through and through. And even now, the Nifty is down about 0.6%. The mid-cap index is down a lot more than that, almost twice as much as that. And the advance decline ratio has been quite negative. There's no taking away from that. You've got over 2,400 stocks declining, just about 600-700 stocks on the advancing side. So what's happening in mid-caps? Where's the selling concentrated? Well, as they say, whatever goes up must come down. So today, look at a lot of the financials, specifically a lot of the PSU banks, even the non-PSU banks. That's where the money is coming off. And also these very, very big high flyers on the railway side of things. Dhanalakshmi is one example. Let me just name a couple of others in terms of major losers. Bank of Maharashtra has had a phenomenal, fantastic run. Stocks down about 4-5% today. The others are on your screen, the likes of UCO. IOB is down about 6% as well. Central Bank. So banks, largely speaking, quite weak. And the other pocket we must take note of, as I said, was railways. Some of these stocks will come up for you, the likes of Ircon, RVNL. These are down about 4-5-6%, depending on which one you're looking at. Railtel is lower. So that's where the money is coming off. Some PSUs, I mean, even non-railway PSUs, look at something like NBCC. So basically, PSUs, railways, banks, this is where the money is coming off. Just a word on Adani Ports, by the way. Stocks down 4.5%. And it's kind of had a rub-off effect on some of the other Adani Group stocks. I just want to mention a couple of the others. For instance, if you're looking at Adani Power in specific, which is down about 6%. Adani Wilmar is down 3%. Remember that Adani Ports is a small operation in Haifa, which is a port city in Israel. They issued a clarification saying that the volumes handled at Haifa port are just about 3% of Adani Ports' total volume. So it's not too much in terms of business impact, but sentiment is very much sort of against anything that has direct linkages with geopolitics. And Adani Ports does have that small linkage as things stand. So, Nigel, let's see, I think a pretty critical 1 hour coming up.
Well, that's right, Surbhi, and that intraday low is something that we'll be tracking for the next 1 hour or so. Just wanted to highlight, these, the index may be struggling a little bit, but sometimes these opportunities, they throw up a good chance to build a good portfolio. Just a couple of stocks I'm looking at. TVS Motors, as we speak, that's moved to the high point of the day. And Ashok Leyland as well has also spiked up. So, it's a good time when you get some kind of uncertainty to build your portfolio with the longer term. Not to say that we can't correct on the index further from here, but there'll be select stocks, particularly well-run, good stories, good managements as well, that will do relatively better. The question is on the index. How do you position yourself in the final hour of trade? Mitesh Thakkar joins us to help us out with exactly that. Hi, Mitesh. Good afternoon. Well, it's that sort of a day, right? If you bought the dip, you would be very, very happy. But you need to book out as well, because at higher levels, again, we did see some bit of selling. Now we're closer to around 19,500. Your view?
I think, what happened was that we did bounce back, but we hadn't taken any long positions. The reason being, yesterday, the low, or rather on Friday, the low was 19,589. And we thought, with the gap down, if the gap gets filled, it'll be sign of strength. And we actually went to 19,588.95. So only about 45 basis points lower than the gap, and the gap didn't get filled. So I think while it's a very small gap, technically, I think the idea remains that now there's an area on the chart which needs to be filled before, some kind of strength can come in. So waiting it out, I think this is not a market which is giving you clear direction. Very choppy, because we had 2 days of rally. Both those days, which is Thursday and Friday, were with gap ups, and then we got a gap down. So difficult to trade the index, but trade with some kind of stock specific biases. I have Tata Consumer as one of the buy calls. That's inching up nicely, and the intraday setup is positive here. So take a very tight stop at about 871, and a target of 895 can be looked at. And Aarti Industries, that's on the sell side. That's a sell with a stop at about 482 for targets of 455.
Okay, Mitesh, do stay on. We want to just get a little more stock specific, and this time the stocks which are backed by different brokerages which have initiated coverage on stocks. Surbhi joins in with that list. Surbhi.
Thanks so much for that. So I have three interesting initiating coverages. The first one is on Stylum Industries by HDFC Securities. They have a buy rating with a target price of 2300. They say Stylum is the fastest growing laminate company in India. They're gaining market share in both domestic and export markets. Their acrylic segment is also growing at a rapid pace, and they expect this segment to grow at over 50% compounded growth in the next 3 years. The company is also focusing on brownfield expansion and laminate debottlenecking to drive growth. They are valuing it at 22 times September 25 EPS, which is still a 35% discount to Greenlam's valuation multiple. Next is on Gravita India, and this is by Antique. They have a buy rating with a target price of 1250. They say the company is one of the global recycler of non-ferrous secondary metals and plastics. It is the beneficiary of increased supply of scrap coming into the organized market. They expect the market share of the company to improve to 16 to 18% levels. Aggressive capex is also going to drive growth, over 31% volume growth in the next 3 years. They expect revenue and EBITDA to grow in the range of 24 to 28% in the next 2 years. Ambit has initiated on IndusInd Bank. They have a buy rating with a target price of 1650. They call it the leader of the middle pack. The company has scored over mid-sized new-gen banks with lower cost of funds, less risk on balance sheet, and more diversified loan book. They estimate 19% EPS compounded growth and 16% average return on equity over the next 2 fiscals. They expect the NIM contraction to be at 15 basis points in the next 2 fiscals. They say they deserve premium over the other mid-sized private banks.
Okay, got that. Thank you very much for the details in this one. Surabhi, thanks for joining in. We have Deepan Mehta joining in from Lexer Equities. Deepan, good afternoon. Good to have you on the show. Before we talk about IndusInd and some of the private names, just want to get your quick take on the profit taking that's going on in PSU banks. Now, I don't know if you participated in this crazy PSU bank rally or not, Deepan, but if you have these stocks in the portfolio, would you book out now?
Good afternoon, Surabhi, and thank you for having me on your show. No, I don't think you should book out at this point of time. I think you're looking at a fabulous September quarter for the PSU banks, and in fact, such corrections are good trading opportunities. We are seeing that price to book, price to earning multiple getting gradually re-rated. And in fact, I would go for some of the weaker PSU banks from a trading perspective or even a short-term gain perspective, like UCO Bank, Bank of Maharashtra, Union Bank of India. These are the ones which where the valuation comfort is even higher. So I'm not that perturbed about the correction in PSU banks. I think some of the weak players will be getting shaken out. But from a 6 to 12 month perspective, I think these stocks are still solid.
Do you look at Stylum Industries, Deepan?
Not that closely, but all these medium density fiberboard, laminates, even plywood companies, last 2-3 years, they haven't done that well. And that's surprising because we are seeing a boom in real estate. And on the whole, I think it's a great secular growth trend where people want to improve their houses and offices. But somehow, for some reason or the other, these companies really haven't delivered on the performance front. Maybe it will change over the next 2-3 quarters or so. But from point of view of a medium-term investment perspective, I think a lot of the positives have got factored in. And I would rather go with Green Panel or, for that matter, Greenlam, because in case of Greenlam, they have very strong export business as well. And that kind of acts as a diversification, product diversification or geographical diversification matrix for the company as a whole. So I would go for the market leader rather than Stylum. But of course, I think I heard your report on Stylum. The story does look quite interesting.
Story does look interesting. What about the port companies, Deepan? Any thoughts? Adani Ports is down 5, but actually I looked at JSW Infra, the other listed port company. That is also down 5 today, after having a fantastic debut very recently. Any thoughts?
Prashant, I don't think it's just overall market sentiment and correction which we have seen in mid-cap stock, which is having a negative effect on these companies. Whatever geopolitical events are taking place is not going to have any impact on India's port volumes or the valuations of these companies. So it's just, I think, overall sentiment. And if you see, the PSU banks are dropping, these port companies are going down. Some of the more, I would say, stocks where there has been a lot of trading interest, Those are the stocks which are under correction at this point of time.
All right, Dipan, what about Suzlon? You know, we had the management of Inox Green earlier today. Both these two, they have fallen from the top big time, but they're in the right sector, it seems. What's your view out there? Suzlon, as we speak, is down close to 5%.
Again, it's the same story over here. Sorry for the sunlight coming on my face. It's the same story. I think these stocks have run up a bit too much, and there's a lot of trading interest in this. Stocks like Suzlon, I think a lot of traders are buying even on margin funding, and some amount of profit booking taking place over there. I would say that weaker hands are getting shaken out just now, but the long-term story for Suzlon keeps on improving. So I think corrections are good opportunities. One could look at it. The order book position is growing pretty well, and most importantly, they are now starting to supply the 3 megawatt windmill, and if that is successful, then they have a lot of orders in that particular segment. And if that works out well for the company, I think clearly it's out of the woods, and I would say one of the strong comeback stories of 2023.
Okay, so one sector which is in the green today is IT. So you've got names like TCS, HCL Tech in the frontline pack, mid-cap names like L&T Technology up 1.5%. Birlasoft is holding up in the green 1%. We've been talking about the TCS buyback, but just want to quickly apprise our viewers, should we expect a buyback from the other IT companies? Well, the answer is not really. Amongst the large cap IT companies, 3 of the IT companies are very regular with their buyback, which basically means as soon as the buyback ends, after a cool-off period of 1 year, sooner rather than later, they announce the next buyback. These 3 companies are TCS, Infosys and Wipro. Now, TCS, we've been anticipating and hoping for a buyback even in the last quarter. They've announced a buyback. But the other 2 companies, which are very regular with their buyback, are Infosys and Wipro. But they just completed their buyback this year, which basically means that in the near future, we cannot expect a buyback from them. The other 2 IT companies, HCL Tech and Tech Mahindra, have been rather irregular with their buyback. For HCL Tech, they've only done 2 buybacks, and the last one was in 2018, while for Tech Mahindra, the last buyback was in 2019. They don't generate as much cash. They've been fairly acquisitive. That's the reason why they've not gone down the buyback route as much as what their peers have. So basically, in a nutshell, if the other IT companies are going up on the hopes that the large cap ones, that we should anticipate another buyback in the near term at least, don't expect one. Infi completed its buyback just in February of this year, while Wipro completed it in July of this year. So still, some time away when it comes to that. Dipan, a quick word on the IT stocks positioning ahead of the numbers.
Yeah, I think you're right, Rima. IT stocks will be the first of the block, and we'll get to see what the managements have to say. But I'm not that optimistic on IT stocks per se at this point of time. And I frankly do hope that, the high flyers, the ones like Tata Elxsi, KPIT, Persistent Systems, Coforge, they're able to deliver, I would say, mid-teens type of growth rate, because that is what the valuations are factoring in. And my sense is that there's more likely to be disappointment than positive surprises for software stocks. So I'd like to be a bit light as far as these companies are concerned. And from a fresh investment perspective, it is better to wait and see what the managements have to say before increasing exposure to the sector.
Okay, got that. Deepan, that's your take on IT. We do have to take a very quick break. Do stay on. We'll have more questions for you coming up in just a bit. We take that break. Also, just a reminder, in the next couple of minutes, we'll also have Sanjay Parekh of Soham Asset Managers joining in. Welcome back here with us on Closing Bell. Okay, let's take a look at the shape of the market. Not much is changing. I'm still 130 down on the Nifty. That's how it's playing out. And banks have been selling off quite a bit. There's no support coming in from banks whatsoever. IT, which was, slightly better off in the morning, now that's coming off as well. But Deepan, I'm trying to look on to the positives here, and let's talk autos for a second, because we've seen the numbers on the first and second, and we were speaking with Fada today. So even on the retail side of it, Fada is saying numbers are looking great, barring tractors. Everything else is doing very well, especially two-wheelers, where I think after COVID, now we're seeing the first signs of a recovery. The problem is stocks have already run up a lot. These stocks, two-wheelers, especially like Bajaj Auto. Anything more you'd look at? Any fresh purchases in auto at this point?
No, I think you're right. The stocks have run up because there's momentum behind OEM sales per se, but still valuations are pretty reasonable across the board. And what is more important is not just the volume numbers, but the average sales realization is also moving up smartly. I would say high single digit to low double digit kind of increases in realization because of the premiumization trend which is taking place. And there could be very decent numbers coming through for the September quarter because raw material prices also have been pretty much benign. And rising interest rates, which we have seen, I think that has not affected the demand for auto shares or auto demand per se. So very positive on auto companies. Our preference remains for a stock like Eicher Motors. Slightly disappointing figures for September, but I think has a great runway for growth. And again, a disclosure, we and our clients are invested in it. And Maruti also, I think, is another favorite of ours.
Deepan, thank you very much for joining in. The Q2 earnings are just round the corner. It kickstarts with IT. TCS is on Wednesday, but not just that. Nimesh is joining in to talk about what we can expect from all the sectors, not just IT, but even the others like banks, autos. Nimesh, take it away.
Hi, Ramera. So it's going to be a very interesting quarter to track, frankly, from the fact that the markets are at all-time highs. And this will be a big impetus for the stocks to rally from here on. So I've looked at multiple brokerages and come out with, let's first look at the overall picture on what the overall quarter two is going to look like. In terms of overall numbers, it's going to be a strong quarter, but that's going to be largely dominated by domestic cyclicals. Not every sector is going to do well. If you look at the, I was just looking at the net profit estimates across multiple brokerages. Then for BSE sensex, the net profit estimate is close to 19% YOY, and 2% quarter on quarter. However, for Nifty, the net profit growth is going to be 23% YOY and a flat on a quarter on quarter basis. So that's the overall net profit picture. If you look at the EPS estimates, which most of the brokerages have put out, the number looks quite interesting. For FY24, for BSE, the FY24, look at this estimate. For Sensex, the FY24 estimate is 3078, and for FY25 estimate, it's 3544. However, for Nifty, the FY24 estimate is 952, whereas for FY25 is 1076. So that's the overall numbers as far as Nifty and Sensex are concerned. If you look at the, if I just drill down to the sectors, in terms of individual sectors, there are few pockets which are expected to do well. That includes the likes of autos, FMCG, capital goods, NBFCs. They are expected to do well. Cement, FMCG, and healthcare. These are a few sectors which are expected to report strong quarter in quarter two. However, there are some pockets which includes large cap IT. There are some other sectors, which will report the weak in terms of weak numbers. So that's one to watch out for. Consumer discretionary will be weak. Large cap IT will be weak. Defense will be weak. And chemicals will actually report quarter-on-quarter decline for this quarter as well. So that's the overall sector picture. Now, I just looked at individual sectors and a few things to watch out for. For example, the financials. For financials, there will be strong loan growth, but there will be NIM compression quarter-on-quarter for most of the banks. So that's a big takeaway as far as banks are concerned. But within NBFCs, I guess MFIs will do well, and the diversified NBFCs, which includes the loan companies, they are expected to do well within the NBFCs. So between banks and financials, you're going to see this dichotomy in the financial space. So that's the first one. Now look at IT. The top 6 IT names are expected to report a single-digit growth or a decline in terms of 0.8 to 1.5% and a flat EBIT margin. But that's not going to be the case for the mid-cap IT. The mid-cap IT is actually expected to outperform large-cap IT names in terms of growth in the range of 2% to 6%, and they're expected to beat on margins as well. So that's the IT sector for you all. Now look at the next big sector, which is OMCs. Now, OMCs last quarter was quite interesting. It was expected to report very strong numbers, but the stock didn't do well. But this quarter, expect a sharp decline in profits because there is going to be a big hit in terms of diesel margins turning negative. So that's for OMCs to track. But gas stocks should expect a strong margins on back of higher volumes and lower volatility in the international gas prices. So that's autos and gas companies for you all. Now look at the autos. Autos is one sector which directionally should do well because input prices have gone down, operating leverages come in. So margin should improve for most of the auto names in Q2 as well. So that's auto sector. Look at the other sectors. The next one is cement. For cement, the volume growth expectations for most of the brokerages is between 12 to 14% as far as volume growth is concerned, but a flat EBITDA per ton in quarter-on-quarter basis. So that's cement sector for you all. Next big sector is pharma. Pharma is going to be interesting. It's been seen as a defensive sector, but this time the US-facing companies are expected to do well because the generic Revlimid will come into picture and moderation in the generic prices as well. However, the domestic companies are expected to see some slowdown due to tepid, seasonal infection as well. So it'll be a different quarter for pharma companies, so to speak. The next is consumer durables. Now, consumer durables again, it's going to be a mixed quarter. Some of the companies should do well within the consumer names. For example, cable and wires, they'll expect to do a strong quarter in Q2. But within apparels, this was that indication last quarter as well. Trent is expected to be an outlier in this quarter as well. Remember, last quarter after the results, the stock rallied 20%. So Trent is something to watch in the apparel space. The next is consumer staples. Again, it's going to be a very soft quarter, single-digit volume growth and a mid to single-digit value growth for most of the consumer staples. So no big surprise is expected there. And the last one is specialty chemicals. In fact, there will be another quarter which will report a very weak quarter in terms of weak demand and weak pricing as well. So that's the overall picture in terms of individual sectors. But clearly, from a market point of view, I guess domestic cyclicals is which is going to drive the Q2 earnings.
Okay, all right, Nimesh, thank you very much for that. Interesting kind of compilation of all views across sectors as we go into the second quarter. Sanjay Parekh is founder and CIO at Soham Asset Managers. He's with us now to take some questions. Sanjay, good to have you back on the program. Thank you for your time. I was looking at the portfolio positioning, basically your weight in sectors vis-a-vis benchmark weights. You're still overweight autos, staples, you're underweight, IT, you're underweight. I think banks also, you're in line, right? Maybe slightly on the underweight side. If I got that right, and correct me if I'm wrong, and what's the new idea? And how are you looking at this phase of turbulence? I mean, actually just one day, because last 3 days, the market's been actually recovering. Over the weekend, we had some of this, conflict out of the Middle East. And today we are down a little bit, but how are you looking at it? Go on.
Yeah, so thank you, Prashant. So basically, we've been positive on domestic cyclicals and on financials as well. We are neutral right now. On banks, we are neutral. On the overall financials, we are overweight. But domestic, the entire theme we like, the cyclical piece, the autos, the cement, as I said, the entire financial space, telecom, domestic real estate. So these are utilities. So these are the areas we are overweight. We are underweight on IT now for almost since inception, and it's a big underweight, which we continue to, we plan to continue for a while. And we neutral on pharma. We are a mild underweight on metals, and also on FMCG we are underweight mainly because of valuation. So
Sanjay,
this is our positioning, and by and large it's worked for us over the last 16 months.
When you say you plan
Prashant,
to... Sorry, go ahead.
Yeah, please. Yeah, so on markets, Prashant, valuations, as we discussed, are not that cheap, but now, we've seen some time correction. If we take earnings, as you just highlighted, Nimesh just highlighted, around 950, 960 for 24 and 1,080 to 1,100 for 25. And let's say India has by and large got 20 times. So that would mean 21,600 over next 12 months on 25. It's good returns from here, but a little bit 3 to 5% lower is always a possibility given the geopolitical risk, given the inflation globally is higher. Crude is volatile and on the higher side. So we will have to keep note of that. Interest rates would transmit now at higher rates. So all these factors put together, we need a little more margin of safety, but structurally we are very, very positive.
Sanjay, just coming back to that point about IT, you've been underweight on IT. You plan to stay underweight on IT for a while now. How would you define for a while? When do you think it would be the right time, or the inflection point in IT will take place?
Yeah, so Rima, essentially, basically we buy IT in great return ratios, and ROCs, payouts are very, very good. But the main point is growth, which is missing, So we don't, and the valuations are not that cheap. So if you get the larger names, TCS at 24 times 1 year forward, or Infosys at 21 times 1 year forward for 7-8% growth for this year. Clearly, we are seeing uncertain times. But more importantly, we're not even clear for FY25. So if there is a hard landing, and if rates are going to remain higher for longer, as Fed is suggesting, then and inflation is sticky, then obviously we could see more effect on tech spend. And that is our worry. And then, as I said, the valuations are really not cheap. So at best, we think it will remain sideways, but we would enter at more like, some more time correction, some more clarity, and maybe 6 to 10% lower. But it's a dynamic world, so we'll be open. But right now, this is a...
All right. Hi, Sanjay. Good afternoon. It's heartening to see that you've outperformed the benchmark since your launch in May 2022. And I say it's heartening because your portfolio is more skewed towards large caps. That's 70-75%. And in spite of that, you have given returns of more than 30%. In comparison to Nifty, that's around 20%. So that's good on you. But I wanted to ask you about two sectors in particular. One is on the banking names, where your weightage is more or less in line with what the benchmark is. But HDFC Bank, the weightage is relatively lower. So your view on that big daddy, because that's not moved and that's been a relative underperformer. And the other point is on consumer staples. You're underweight out there in comparison to what the benchmark is. Ahead of elections, will you look to add some weight out there, HDFC and consumer staples? Go ahead.
Yeah, Nigel, thank you. So basically, financials, we're structurally very positive. And as you see, we have all the larger banks in our portfolio. We are mild negative right now. But otherwise, the larger banks, be it Axis Bank, ICICI Bank, SBI, even HDFC Bank, we are positive. We think this is really structural. The valuations by even by historical standards are very reasonable. Earnings contribution even this quarter and this year would be very good. At an appropriate time, we'll further move up on banking as an overweight. Overall financials, we are positive. We are overweight, led by NBFCs. And so the overall financials, we are positive. On HDFC Bank, we own it. We genuinely believe it's a very good long-term story. There were certain concerns on NIM compression for this year and hence lower growth rate. But we feel that over the next 2 to 3 years, the combined HDFC Bank will clearly be able to get growth at an accelerated pace and get back their ROEs and return ratios also coming 25 to 27. So we obviously cannot exceed 10% in the bank because of the SEBI regulations. At an appropriate time, clearly we'll try to get there. But I think it's a little bit overdone in HDFC Bank, and we expect it's underperformed the last 2 years, but this could be one where the rear view mirror will not help, and it is better to look ahead of the next 2-3 years.
Okay, got that. By the way, that's news that's known to the market. This was announced by Bajaj Finance last week. They're looking at equity fundraising. They're doing a mix of a QIP as well as this issue of warrants to the group entity, parent entity, which is Bajaj Finserv. So that 1,200 crores, no news came in yesterday. Now they're giving out the timelines and as to when the shareholder meetings will be called to execute the same thing. That's a stock in news. Sanjay, so if you were to put fresh money to work right now in this market, first of all, would you do that or would you stagger it out? Would you hold some cash? And if you were putting that money to work, then where would it go?
Yeah, so we would be gradual, and because I'll be very honest, there are not too many good opportunities at the right valuation. So it's very important to get the right entry price. And that's a very important source of alpha for us. So getting the sector right, getting the stock within the sector right, and most importantly, getting the entry price right. I think the last one is a little tough. There are opportunities, but even in Nifty or even in mid and small cap, there are opportunities for sure, but not exactly at the comfort zone of entry price. So if we get money right now, we will be gradual in our deployment. But if the markets were to, say, react 3 to 5%, and if we get select stocks at very good levels, we'll be very aggressively deploying. Because we are structurally very positive. It's just that we believe there could be some time correction and some price correction. At the same time, if we get a stock even at today's level, where we think there's great opportunity, we are very open, provided it fulfills our valuation comfort zone. That's only.
Got that. All right, Sanjay, we'll leave it on that note. Thank you very much for joining in. You have a good rest of the day. We look forward to the next chat. All right. We'll take a break on that note. And as we do that, let's tell you about one of our newest digital offerings, the Market Cafe. Now, this is a show that mixes markets with an element of chill as well. This week, I caught up with the Marcellus investment manager, Saurabh Mukherjee, and chatted with him about the wealth explosion that seems to be underway in India, particularly in India's southern states. And we also spoke about the rise of women. Saurabh says that these are mega themes and can be good from a stock investment point of view as well. Take a look.
Over the last decade, as the Indian economy has become even more oriented towards services, and in the manufacturing sector, our manufacturing boom has been saying more sophisticated products such as pharmaceuticals, such as light industrial manufacturing. South India, with its greater sort of literacy orientation, right? A higher proportion of literate people, greater access to seaports, greater ability to give law and order, provide law and order to factories. They of the north. So if you look at the per capita income data coming from the government, states like Telangana, per capita income has almost doubled in 5 years, right? Absolute explosion of prosperity.
Really? Telangana doubling of per capita?
Yeah. Karnataka, Telangana, Tamil Nadu, Kerala, I would even include Maharashtra in the southern seven, right? So if you take Maharashtra, Goa, and then go all the way down to the southern states. So I'll give you an obvious example and a slightly less obvious example. So an obvious example would be a company called Rainbow Hospitals. This is a maternity and pediatric chain, which we invested in a few months ago. In Mumbai itself, you'll struggle to get above 40-50,000. But in South India, in the 17 hospitals that Rainbow has, typical hospital has 200 to 300 beds. It's not a problem because women are
South India being really affluent.
That's right.
And women dominating, again, the same question. So how do we play these themes?
I think one of the most straightforward ways to profit from women's prosperity is called Gerber, G-E-R-B-E-R. So this has been sold in the West by Nestle to India. This is expensive stuff, but as the Indian woman's income skyrockets,
Welcome back. Well, the market continues to remain under pressure. We're down close to around 150 points approximately. And the Nifty Bank, that's the one that's cracking, and it's approaching that level of 43,800, which from where we did see a bounce last week. So the bulls will be looking at that level very, very closely, because if we break that level, we slide down straight to around 43,100 odd. But it's a good time to shift focus to our special segment, where we move to D-Street Chatter. Nimesh joins us to tell us what he's picking up with regard to dealing rooms. Nimesh, not a good day. It wasn't supposed to be a good day. Intraday bounce, but that got sold into.
That got sold into, right, Nigel? Again, days low. I guess first of the big geopolitical risk, though, there is a bit of uncertainty. Nobody knows as to how this is going to pan out, right? I guess the big takeaway for me was one, in the crude derivative segments with the likes of paints, aviation, those kind of stocks is getting sold into. So there is a bit of nervousness now from large institutions in the crude derivative stocks, so to speak. But I'll say the flows are mixed because of the fact that the domestic liquidity is so strong. Domestic mutual funds are sitting on cash, so some bit of deployment has happened today. I'm told that the DIs are not very aggressive buyers, but they are nibbling at lower levels into select stocks. So that's, I think, is going to be a cushion for the markets as well. The fact that the DIs are sitting on a lot of cash. I guess from a positioning point of view, 19,400, 19,450 is a level to watch on the downside. If that gets taken out, then probably you'll see a sharp lot of. So the feedback is that that's one level to watch out for. But broadly, the feedback is while FIs are net sellers in some selectives, there is support coming in from DIs into the select large cap as well as the down market. That stock is up 10% on good volumes as well. I guess the street is anticipating the long pending merger to come very soon. But I understand there's going to be a large block in Inox Wind very soon. So that's something to track in that particular stock. And the last one is Dabur.
Back with us, and there's still no big recovery in the markets. 19,520 on the Nifty. Mitesh is back with us. Mitesh.
I have, in fact, STBT calls. It's a market which is not very comforting to carry long positions, and because you kind of recovered from the lows. The closing is still on the weaker side, especially on the bank Nifty. So I'm slightly worried. I'll take a Deepak Nitrate as a STBT with a stop at 2090 for targets of 2030, and Dabur as a STBT with a stop at about 545 for targets of 534.
Okay, got that. Thank you very much, Mitesh, for your trading calls today. We'll see you again with the market tomorrow morning. Anand Tandon is with us now. Anand, hi, good afternoon. We were just, discussing this a while back before you joined as well. I think today's talking point is really Adani Ports because of what's happened over the weekend. Geopolitics in focus again, right? Now, Adani Ports has clarified that Haifa is only some 3% of their total volumes, total business. So it's not that big, but sentiment is negative. How would you look at this stock overall? There's geopolitics on one end of it, but then a lot of other things have happened this year with the Adani Group. Does this one merit a look? Do you find value here?
If you take out the geopolitics, I think Adani Port is probably the one stock in the entire Adani Group that merits investments. There is no question about the kind of monopolistic position that they have almost developed within India. And now across the region, they are also expanding their footprint. That said, global trade is a function of the geopolitics. So it is, would I be rushing in to buy immediately? I think not. One has to wait to see how the problems in Israel work out. And my assumption is right now that things could go down the tube quite quickly if there is a greater involvement of the other players other than just Hamas and Israel. So with that caution, I would argue that this is not necessarily the time to be adding immediately. Wait a little bit. Yes, whenever there is a problem geopolitically, it doesn't affect over a longer period of time. But if it does escalate a little at this stage and it's very early days yet, you could find better entry points than rushing in immediately.
So since we discussed ports, just to follow up on this, Anand, we have another big private sector port operator, right? The new listing, JSW Infrastructure. They're the second biggest in the country. Since you seem to like the space, X of geopolitics, what did you think of JSW Infra?
So, I think if you look at Adani itself, they are only operating at about 40% capacity. Why, when the market leader by far, and as I said, it's not simply a question of how much trade there is, also the geopolitics and the strategy about how they are going about doing their business. I find Adani is, has captured most of the major ports and also now
they've dovetailed themselves to the policies of the government, because if you are looking, for example, to the kind of announcements that were made in the G20 of the trade route between here and Europe, you would find that Adani is right positioned in the middle of all of that. So if you have to be looking at it, a capacity which is still not even half operational, a business plan which looks quite solid, and a chain of ports which are well positioned, why would I go down the curve?
Anand, the India-UK FTA negotiations are going to be beginning today. The expectation is that deal will be signed. Can you explain how this exactly impacts the textile companies in India? Have you done some analysis? Why is this important, this UK-India FTA?
Well, I haven't done that in the context of the textiles businesses per se, but broadly, the question is what is the rate at which you're getting taxed? And except for countries like Bangladesh, etc., where there are almost no taxation for most of the developed market, especially Europe, the Indian goods do get taxed at various levels. If the FTA takes that out, obviously almost all exports from India, and textiles is one of those places where we have a strong position, would benefit. Most of the other exports that we do may not have the same kind of delta in terms of taxation, and therefore may not be having that much of a beneficial impact. However, that said, there will be other areas that one has to look for, because one of the sticking points in the UK FTA, for example, has been liquor in India and the kind of taxation we have there. So there would be opportunities there as well for either going long or short some of the other commodities. But we are still some distance away from signing up an FTA, I would argue. So one should not be jumping in to just play that market. The textile market has been a little sluggish over the last few months, and just an FTA doesn't change that till the domestic demand also picks up considerably.
Anand, do stay on. We want to just turn our attention back to that big global development which took place over the weekend. Palestinian militant outfit Hamas stunned Israel with a surprise attack. In retaliation, Israel has declared war on Hamas. This is the worst assault on the state of Israel in over 50 years. Prashant has moved over to the big wall, and he's going to take us through some important time periods in the history of Israel and Palestinian and how it impacted markets when we've had past skirmishes.
Absolutely tragic developments with the conflict erupting in the Middle East over the weekend. Now, the Israeli Prime Minister Benjamin Netanyahu on Saturday said that Israel was going into, and I quote, a long and difficult war in response to the very large attacks by Hamas on Israel. US President Biden has pledged rock-solid support for Israel. But, without getting into all of that, and that's not the purview of this presentation, let's look at how markets have responded during periods of extreme tension between Israel and Palestine. Let's look at the sort of most extreme periods, right? So I'm going to put out four, and this is going back 20 years. This is the second intifada, which intifada is an Arab word which basically means rebellion, uprising. This lasted a full 5 years. Escalated violence that ended with withdrawal of Israeli forces from the Gaza Strip. Let's move on to the next one. This is what's called the Gaza War, the first Gaza War, December 2008 to January 2009. This lasted a period of 22 days. Some of these are very sort of, compressed conflicts. The next one is July 2014 to August 2014. This lasted a full 52 days. And then the fourth one was an 11-day sort of conflict. And this was in 2021, May to June 2021. This was the shortest in terms of what we are putting out. Now, the question is, how did markets react in each of these conflicts? I'm excluding the 2000 to 2005 period because, no point looking at markets over that time frame. The second one happened during, that's the 2008, 7-8, happened during the global financial crisis. So again, there were other factors playing on markets, not just this one. So it's difficult to isolate. So we're just looking at 2014 and 2021, very sharp, July, August 2014 and May, June 2021. Look at US equities, around 5.5% cuts there. The 10-year yield, because it's a risk off, 22 basis point fall. And in 2021, there was a 20 basis point fall. By the way, implied open for US yields this morning as we speak, you're seeing about an 8-9 basis point cut fall. Oil prices, now this, you may wonder why is oil price down 12% during this period. Is largely because in May of 2014, prices had hit $120 a barrel. So it was coming off of very high levels, and that's the reason why, there were some other things which went into it, but prices were down 12%. But look at the other one, which is 2021. Prices were up 19%. And that's the big one, right? Oil, which makes an impact for us as well. And of course, Israeli equities themselves were down sharply. That's the market reaction in previous episodes, but no conflict is the same. The factors playing on the markets are always different, always changing. The hope is that the conflict sees de-escalation quickly. But just earlier this morning, Wall Street Journal cited senior members of Hamas and Hezbollah saying that Iranian security officials helped plan the attack. The risk really here is that the conflict escalates into a more severe proxy war between different old enemies in that region. Back to you. Okay, welcome back. You've got the market, which is just about 8 minutes away from closing, and there is a fresh leg down on the index. We are just breaking 19,500 as we speak. I thought that I looked at rates about 10 minutes back, and U.S. markets had cut their losses. So U.S. is down 0.6%, so not really, but yeah. I think Dow futures are down 145, so they were down 200 to almost 250 at one point, a little before when we started. European futures, nothing. FTSE is up a little bit, DAX is down a little bit, but there's nothing large or significant which is actually coming through at this point. Here, of course, there is a give back which seems to be happening that started earlier. Anand, we'll just present data on elections in just a bit, but dates have been announced for state elections later this year. Actually, it's pretty soon, starting November, 7th of November. There's Chhattisgarh, Rajasthan, Madhya Pradesh, the big ones. Any thoughts in terms of how markets will trade around this important event?
Well, I think the market will obviously depend. More than the election, it's the results one's looking at in December. And, there is a certain assumption that the market makes as to which party will win. But frankly, on a slightly longer term basis, this is where I am a lot more sanguine about the profitability, about companies and stocks. If there is any negative outflow out of the elections, that would be an opportunity to buy. I think the geopolitics is not so easy to brush away. The elections are.
All right. Hi, Anand. Good afternoon. Anand, GMR Airports, it surprised everyone. And we're getting into the peak season as well in terms of travel, hotels. You have the World Cup as well. Now, that stock has come off close to 15% from its 52-week high. What's your view on the stock? As we speak, it's down close to 6%. But that could be another theme, right? That will play out?
Well, yes, they are also increasing the capacity here in Hyderabad, which is one of their flagship airports. And as a company, they have managed to get out of most of the other activities. So the GR airport is definitely a theme, but you have to remember that, increasing costs for airlines is not necessarily a great way for airports to make more money. And the rest of the rental, etc., right now is already more or less fixed. So you have to look for incremental growth coming out of rental income and non-transit related income to be able to sustain. So it's finally a utility kind of earnings growth that one should be looking for. Right now, of course, the numbers are looking much better. But the valuation probably was a little stretched compared to where it could have been. So longer term, it's definitely a place to be if you are willing to accept this company as a utility.
Anand, I know you've been maintaining the markets are stretched. It's difficult to find bottom-up ideas, value right now. But anything that swum into your ken right now?
Well, I mean, if you have to be investing, there is, of course, as I have been saying, that the private sector frontline banks have not performed. So that could be one place that one could be looking at. Some of the smaller jewelry companies outside, for example, Titan, have been reporting tremendous numbers, and we are anyway getting into the festive season. So those are the areas that I would be looking for in terms of domestic consumption. Export, a lot more iffy. Some of the pharma companies exporting to developed markets like the US, etc., which haven't done as well as as the others, could be companies that could look at. I mean, for example, Aurobindo has been performing rather miserably, but I think this quarter they may actually do a reasonable number, and the growth is expected to be quite good. Of course, they've already, the stock prices of the recent past done reasonably well, but it still remains among the cheaper stocks. So again, not a recommendation, but those are the areas that have not performed are probably the only ones that one could be looking at. And here too, one would say that you should be looking at domestic consumption rather than anything else.
Anything new you bought recently, Anand?
Well, I have been, if you ask me personally, I think the US market looks a lot more interesting. So I've been focusing on that for now.
And what there in the US? An ETF or something?
I'm sorry?
An ETF or was it a single stock?
So both, but I mean, if you, for example, take some big themes, right? I mean, if you look at China +1, which is something that India has been talking about, if you really look at it, the one country which is benefiting from offshoring manufacturing out of China, it has been Vietnam much more than India. So, why not look at an ETF for Vietnam? It's a difficult market to trade or invest in. Not too many stocks which are liquid enough. But there are ETFs that can be bought. So, you could look at that. But in India, for example, there is no Vietnamese ETF which is available. So you have to look at international markets.
Anand, we leave the conversation there for now. Thank you very much for joining in. Just about 2 minutes left for markets to close. It's going to be a close firmly in the red, down 1.5%, given the Middle East turmoil, the rise that we've seen in Brent crude prices overnight, and even the surge in the dollar index to levels of 106.5. So globally, markets have been under pressure through the day. The Nifty is ending around 19,500, not at the day's low, which was 19,480, but closer to that. 150 points lower on the sensex. On the Nifty, the sensex has shed 470 points. The mid and the small cap universe has taken a bigger beating. So fair amount of pain in the broader markets. Mid cap index down 1.5%, small cap index more than that. The advanced decline ratio has nearly 2,500 stocks closing in the red. The worst performing stock on the Nifty is Adani Ports, given the high-fi exposure. Autos have come under pressure. So Pawan Munjal, the FIR filed on him has hurt. Hero MotoCorp, that's down 2.8%. Other notable losers include HDFC Life, M&M. On the gaining side, it's been a few defensive names in the IT and the pharma basket. So Dr. Reddy's top Nifty gainer, the only one with a 1% rally. In the IT pack, it's Sailtech and TCS, where there is that buyback announcement.
Okay, well, I think, it's a down and out kind of day. And I think we are, Rima, as we kind of finish today's session, we're at the lows, almost at the lows of the day, right? I mean, the low was 19,480 and we're at about 19,496. So just barely managing to keep our head above that particular level by 15 points or so. That's it. So by the time you average out the rates, I mean, actually, I think there should be a slight bump higher. But yeah, I mean, this is looking pretty poor as a close. So no real big recovery at all through the course of the day. You know, the second leg of the selling started at around 3 o'clock. Yeah, around 3 o'clock. We were at 19,540 and we've come off about 50 points in the last 30 minutes or so of trade. So that's the close. So you've got a 0.8% cut on the Nifty, and I think you've got the Nifty Bank, which will end down about 1.25% in terms of trade. You look at the mid and small cap part of the market, mid cap down about 1.5%, and small caps, of course, were selling off about 3/4. It's almost 2% actually. The small cap index down 1.96% by close. So starting the week on a down and out kind of a note and giving back 50% of the gains that the Nifty accumulated over the past 2.5 sessions, actually. Well, it's a wrap on this edition of Closing Bell from all of us here. Thank you very much for staying with us, but don't go anywhere. Our special offering, the Market Cafe, comes up next.